Hello and welcome to Accounting Instruction Help and How-To. In this lecture we're going to talk about auditing and assurance services. At the end of this we will be able to define what audits are, define what assurance services are, also define what they are not, explain some common misconceptions with what audits are. We will be able to explain what the role of audits are, how they are useful for society, what they provide for us. So we're going to start off with the basic idea of the audit, and the audit's going to be in relation between two people. The audit usually helps to facilitate trust. So one of the main goals of the audit is to have trust. If we increase the trust and the transparency between a transaction, we could increase transactions and make transactions more readily available. That's going to be one of the purposes for an audit. For example, when we think about a company wanting to do business with an outside user, such as an investor, a bank, or a government, some outside user. If we're talking about the investors, we might be talking about individuals who are investing like their 401k plans into the company or something like that. Banks could be trying to get a loan, or if we're talking about the government, of course, we're talking about income taxes. And the typical idea to start off with is the investor. If we're trying to invest money into a company, into the stock market, we need to get some assurance from the company about the performance so we can make a relevant decision on whether or not we want to invest. How do we do that? Well, we usually have the financial statements in order to help us do that. So the company can provide financial statements to investors in order to trade on a public stock exchange, and then the investors have the information on which they can make the transaction, both sides being better off from this transaction, both the company and the investor. However, in order to facilitate more transactions, we need to make sure that the financial statements are correct. The user of the financial statements needs to rely on the financial statements. So they need to know that the financial statements are right, that they haven't been manipulated or put in there incorrectly. And they also want some kind of conformity, because the investor is going to want some kind of standardization so that they can read the financial statements, compare the financial statements to some standard that they know about. So that's where the trust comes in with the audit oftentimes. So if we think about the company trying to do business with the investor, and then you think about the third party, you can kind of think about a friend in a normal situation. If two individuals are going to do business and they both trust a third party, they can talk to the third party and say, hey, do you trust the financial statements that I'm receiving from this other individual? It's a similar situation here where we have the two parties. We have the third party who we don't particularly know. In fact, they want to be independent. In this case, we're going to say this is an independent third party. And that is why we're going to trust this third party, because they're not directly involved in either side of the transaction. Therefore, if we get their independent decision, that can lend more faith in terms of the accuracy of the financial statements. And if we can get more accuracy in the financial statements, we can have better trust, better transparency between the two parties to the negotiation. And that will facilitate, hopefully, more trade, which is generally a good thing. And just to point out that how good a thing that is, it's worth a lot to have this type of trust within the market. So, for example, our stock market trades a lot of money. Obviously, we get a lot of money into the stock market. And it's not necessarily because we're positioned best in the world to have the highest growth or the highest returns, because the countries that are industrializing, you would think, would have better potential to have higher returns as they go through that industrializing process. But the U.S. still pulls in a lot of money, and a lot of the reason for that money coming to the U.S. is because of the stabilization, the idea that we do have the trust within the system, that we do have kind of the transparency, we do have the regulatory regulations in order to have audits for publicly traded companies, and therefore when we look at the statements, we can say, okay, I do have some faith in this. Now, people may balk at that because there have been scandals, of course, in corporate scandals, and those are the things we usually see in the news. So there's been problems, and there's been increased regulations, and this is an ongoing problem that we're always going to have. But again, the fact that we do have those regulations and the fact that we do have the required audits does generate a lot of capital that comes into the U.S. Now, of course, this benefit is costly too. Audits are very costly, especially for publicly traded companies. So the increase in regulation has the benefit of facilitating more trade and creating that trust. Also has a high cost, because having audits is going to be another hurdle that we have to go through in order to prepare the audits and go through the rules of those. So balancing those two things out, balancing the increase in benefit from the added level of trust, the added level of capital, in transparency in the investments, versus the cost, of course, of the added regulations that would be required to do in order to get that is a constant struggle that we have within the audit profession. One misconception when we talk about what audits are, or at least something that's not an audit in this context, is that whenever someone hears audit, usually they think of tax returns. So many people, when they hear the word audit, they think of taxes. And that makes sense to a degree. A tax audit, meaning the IRS looking at the tax return to see if something or questioning a position taken on the tax return, is a form of review. It's a form of review process. But even the IRS at this point has changed that terminology to an examination. So the IRS, when they question a tax position, they are examining the tax position and questioning the tax position on that. Not necessarily an audit, the audit being something on the public accounting side that is issuing an opinion on the financial statements that are created by the company. So in an audit or an assurance type of services, we're talking about the company creating something as being the responsibility of the company, oftentimes that being the financial statements, and then the CPA firm giving some kind of assurance service in the case of an audit, auditing the financial statements, which are the responsibility of the company, and giving some kind of assurance as to the accuracy of those financial statements. The need for auditing and examination, just accounting in general, has increased substantially over the last 200 years or so, with the increase in the Industrial Revolution, clearly increasing the need for more audits and more engagement. When we had the creation of corporations itself, that will increase a lot of complexity, and the creation of the corporation meant that it also increased business in general. When we then had the stock exchange then puts in a lot more complexity, puts a lot more capital into the market, and also has a lot more risk. The stock exchange being something that was very volatile and could have very high ups and downs. Some regulations in terms of the information being provided to people so that there's equal information on both sides of the transaction became something that was, of course, important. Later on, we have continuing issues, of course, Sarbanes-Oxley. We had Enron resulting in Sarbanes-Oxley and more types of regulations as things get more complex going forward. We're always going to have to balance that idea between regulations and the cost of those regulations when we're thinking about the pros and cons of the auditing process. Now, just to drill down on that a bit, when we think about a company, it's good to just get that idea of what we're talking about with the company. The company being a publicly traded company, or a C corporation being something that's going to be separate from the owners. So we have the managers managing the company being separate from the owners being the shareholders. So if we are investing into the stock market as shareholders, if we have some shares in our 401k plan, then we are the owners in terms of the shareholders. The owners in aggregate are hiring management, putting management in there. Management then is acting as the agent for the owners, the stockholders. It's in a similar way. We can think of it similar to if we were a U.S. citizen or a citizen in a democracy, and they are owning the country, then they hire representatives to represent them in Congress, which would be the politicians. Politicians, therefore, should be acting as agents for the people that elected them. Same kind of concept here. The stockholders have managers. The managers should be acting as agents for the best thing for the owners, being the stockholders. Now, we do have this agency problem. We can see that this disconnect, this separation of the owners from the actual practice of the business can cause an agency problem because, of course, the agents have their own kind of needs too, and their own wants and desires that may not be in alignment with the stockholders. And that's one of the things that an audit can help with. It can help align those with having that third party in there to give some assurance. The managers are there in order to run the business, create the financial statements, and then the auditors can give some type of assurance to the accuracy of the financial statements that are being reported for the people that are investing, the actual owners of the company, the stockholders. Now, when we think about the types of assurances that we try to provide, we can break these up into a few different categories, and we'll drill down on these more at a later time. But we do think that we want to provide some assurance about the balance accounts as of a certain point in time. So the accounts, do they exist? We're talking about the balance sheet as of a point in time. We've got assets, liabilities, and equity. So we could think about the idea, do these accounts exist? Are the amounts being reported actually existing? Now, when we think about these types of ideas, we're usually more concerned with a company trying to overstate their assets, trying to look better, basically. We're more concerned with them trying to overstate their assets and understate their liabilities rather than the other way around. That's where we're going to focus in on. Now, when you think about the taxes, it's usually the reverse. Obviously, for taxes, companies have an incentive to look worse in order to lower their taxes. But mainly we're thinking of audits in terms of someone like the stockholder, and if the stockholders who we have in mind, we want to protect them against the overstatement of the financial statements that would trigger the reaction to those, depending on those financial statements, then investing when they would not have otherwise done so. So for that reason, we're more concerned with a company overstating assets and understating the liabilities. So when we think about existence in terms of the balance sheet account, we're probably thinking about more, do the assets actually exist there? Are the assets that are being reported actually something that exists? Rights and obligations. So when we're looking at the assets, are those assets, do they have rights to those assets? Are they actually owned or are they leased? Now we could also drill down on actual transactions. We can drill down and look at actual transactions, and we're looking for similar types of questions. We want to see, did the transaction actually occur? Are these transactions, did they actually happen, or is something reported that didn't actually happen? Are the transactions that are being reported, are they complete? Did they have authorization? Are they accurate? A big one's going to be the cutoff dates. So many types, all types of audits are going to do some kind of cutoff testing. Cutoff testing is basically the idea that if someone's trying to look better, if we were trying to make the financial statements look better, we might try to pull in revenue from next period into this period, or try to push out expenses from this period into next period. So we want to make sure that the revenue and the expenses are reported in the proper period. And there could be assurances about presentation. So basically, is everything disclosed that should have been disclosed? So if there's any information that's going to be relevant to decision making, we basically want that information to be reported in some way. So for example, if there's like a lawsuit or something that's going to happen out in the future, and it hasn't happened yet, we're not totally sure that it's going to take place. But if there's a significant risk, then it might be something that we should have disclosed on that, because it could have a material impact on the decision making. Now we've been focusing mainly on audits here, but note that audits are kind of in the category of assurance services. So when you think about public accounting firms, when you think about CPA firms, we can think about assurance services being like the wide circle, the big circle encompassing everything. Attestation engagements are going to be within that circle. And then one form of attestation engagement is the audit. So an audit is one form of the bigger circle of attestation engagements, which is in turn in part of the bigger circle of assurance services. Now the broad circle, the assurance services just means that an independent professional service that improves the quality of information or its context for decision makers. That's going to be the broad category in terms of the broad assurance services. In terms of the attest engagements, those are going to be the things we're actually given an opinion, usually a report. So we usually think of an audit as a form of attest engagement, but we could have different types of attest engagements. For example, reviews are another common type of attest engagement. The difference between the two is the level of assurance that we're going to have between those two. So an audit is going to be something where we're going to give our highest degree of assurance services, and we're never going to give complete assurance. Remember what we're doing. We're saying that we're going to report on the accuracy of the financial statements. That is the responsibility of management and gives some degree of assurance, never complete assurance. If we are talking about a review, then we're going to be reviewing with less assurance. And a review would be something that we probably can do more from the office, meaning we can do more analytical type of analysis, ratio analysis, and this type of thing to analyze the accuracy of the financial statement. An audit is something where we're going to go out to the engagement and do a lot more digging into an audit and have a more in-depth gathering of information in order to support our opinion. Now we could also give an opinion on other things. We could give an opinion just on internal controls. We could give an opinion on whether something is in compliance with a certain set of regulations and other types of engagements as well. Now when we think about the full audit engagements, it's a good idea to think about what's the responsibility of management, what's the responsibility of the auditor. It's good to put this in terms. We're going to have an engagement letter. We should have an engagement letter defining what these terms are. What is management? Just an overview of their responsibilities. They're the ones that are going to be running, creating the financial statements. They want to be implementing the internal controls, coming up with the internal controls, implementing the internal controls, monitoring the internal controls. They're going to accumulate the data, create the financial statements from the data, and then they're going to issue the financial statements. As an auditor, we're going to we want to get that engagement letter, and then we're going to spend a lot more time, especially in larger audits, investigating the process, investigating the internal controls. We want to see that internal controls have been set up well. We want to see that they're being followed, that the internal controls, we don't just have a good plan, but the plan is actually being implemented, and seeing that the process is going as it should. And we're emphasizing more on the internal controls than basically other types of substantive testing, because as audits get large, especially if you're talking publicly traded audits, it's very difficult. It's impossible at this time. It would take too much time and money to drill down on all the accounts and look at enough transactions to get the level of assurance that would be needed for an audit engagement. Therefore, many of the new regulations we look at and many of the new techniques that we're going to have will focus more on the process. If we can get the focus on the process right, then we can make a higher level of assurance that the financial statements are being reported correctly. So we want to spend our time there rather than drilling down on the financial statements with substantive testing. So that's going to be our focus. We're going to obtain evidence to do that. We're going to test management's assertions against the criteria. Now, obviously, when we think about audits, we have to assess this against the criteria. We're given an opinion that something is in alignment with some kind of criteria. Usually, that criteria is going to be GAAP, generally accepted accounting principles. Note that if we're talking about if we're talking about a review or some other type of engagement, that type of criteria may be something else. If we were trying to get a bank loan, and the bank said that the company needed a review, and they said that they can get a review in alignment with a tax policy, so the financial statements are in accordance with the tax code reporting or in accordance with a cash basis. Those are things that could happen, but just make sure, obviously, we are testing to see that something is in alignment with a set of rules, those rules usually being generally accepted accounting principles. And then we're going to determine the overall fairness of the financial statement and finally issue a report on them with some type of assurance opinion. A couple concepts that will come up often within the discussion of auditing, that's going to be audit risk, materiality, and evidence. The idea of audit risk is the idea that an auditor has the risk of giving an incorrect opinion, meaning they give an opinion favorable when there's actually a material misstatement within the financial statements. So there's always going to be some audit risk. An audit risk being that we gave the wrong opinion, there's always going to be that in there. So when we actually report the opinion to a standard audit report, we have the statement of reasonable assurance. We're providing reasonable assurance. We're never going to say we gave complete assurance, but the audit is the highest level of assurance we have. The audit, the examination, that's the highest level of assurance that we can provide. A review or something would have less assurance provided on that. And when we measure how much testing we're going to do, we're going to measure it against the level of audit risk and try to reduce, of course, the level of audit risk. The idea of materiality is the idea that something is material if it would have an impact to decision makers. So if something is material, then we want to make sure that we take a look at it. If the financial statements are materially misstated, we're basically saying the financial statements have an error in them that is large enough to affect people's decision making on it. Now that materiality factor will be higher or lower, and we could assign a dollar amount to it in many types of testing for it, and it could be pretty high when we think about large companies, because we're looking at the dollar amount in relation to the total dollar amount. But that materiality factor will be very important. Now, as we conduct the audit, we're going to gather audit evidence to back up management's assertions. That audit evidence is going to include the financial statement and the data that we get. It's also going to include any other information we can get from inside the company as well as information from outside the company. And oftentimes we're going to rely on the information from outside the company a bit more than internal information just because it's from a third party. Such as a bank statement or something that comes directly from the bank. But the idea is that we need to gather that evidence in order to back up the assertions of management. Now, as we move forward through the testing, a concept of sampling will become very important. So the idea of sampling being that we're going to take statistical samples of certain items, certain transactions, and look for the evidence in that way. So we can't test every transaction that happens. We can set some statistical type of sampling methods, and we'll go through different types of sampling methods in order to prove our assertions as we go. Now, the basic phases of the audits are going to be that we're going to first negotiate the audit. We're going to have a negotiation agreement for an audit, either a continuing audit that we have from prior years that we do yearly, or a new audit with the client. We want to have a preliminary engagement activities. Then we're going to plan the audit. We're going to decide how long it's going to take and what type of activities need to be within the plan. Consider and audit internal controls. So we're going to audit the processes, these internal controls, and that'll help us to assess how much other auditing we need to do, how much testing we need to do. Audit business processes and related activities, and then we're going to complete the audit and evaluate results and issue the report. Now, audit reports are usually going to be fairly standardized. The title line of the audit report is going to have the word independent in there. The idea of independence being very important within the audit. We want to make sure that we are an independent third party. The audit report includes an introductory paragraph, a scope paragraph, and an opinion paragraph. If the audit does not reveal any material misstatement that was gathered through the evidence through the audit process, the highest level opinion that can be given in the audit report is the unqualified opinion. So an unqualified opinion is basically saying that the audit report appears to be free of material misstatement based on the audit evidence that has been gathered through the audit process. So qualified opinion, on the other hand, would mean that there has been something that has been found that we believe could have a material impact on the financial statements, and then we'll probably list out what that thing is. And we could say that basically everything else is looking like it's in accordance based on the evidence that we have gathered, with the exception of this qualified piece. Now, obviously, the goal here, we're hoping that we're able to issue the unqualified opinion based on the evidence that we have. If we have to issue the qualification for something that has been not in compliance with generally accepted accounting principles in this case, then we'll issue the qualification and list what that is. If the financial statements do not look like they're fairly stated, then we'd have to issue an adverse opinion. And an adverse opinion could end the engagement, of course, because the company is looking not for an adverse opinion, but if the financial statements are not in compliance with the generally accepted accounting principles or whatever rules or set of rules that we are comparing them to, then we'd be required to issue the adverse opinion.